So people often ask, what are the best places and best cities to invest in? And a lot of times, if you live in a place like I do in Southern California, it doesn't make sense necessarily to invest locally. And so it's important to be able to look outside of your local region and find areas where the numbers really make sense, where the population is growing and where you see businesses moving and jobs being created as well. So my guest today, Neal Bawa, is really an expert. He has some great systems on ways to do this, to discover areas, and it really makes sense where the numbers are actually telling you where you should invest. So Neal, welcome. How are you today?
Fantastic. Thanks for having me on the show, Bronson.
Really excited to have you on. I think you're somebody that I look at and just watch the way that you handle data, and of course you have the nickname of being the Mad Scientist of Multifamily, where you just you're in your lab working with these great formulas and finding ways to discover what the right markets are to invest in. So I wanted to explore that today. So can you talk with us a little bit about why some markets are better than others, and how you kind of go about approaching the right areas to invest in?
Yeah, well, I'll start off by kind of giving you a 1 minute background, and then I'll answer that question. I think the background will really help. I'm a technologist, geek, dork, nerd, whatever you want to say it. I'm steeped in Silicon Valley culture, and for us, everything comes back to numbers. We're like Neo. We're reading the matrix, so to speak, and that's the culture that we come from. And when I got into real estate, I noticed that people were giving lip service to data. They weren't really making their decisions based on data. And the most prominent example of that is, there were companies that would do well. They'd give money to their investors and, never lose money, but they would stay in one metro over 5 or 10 or 15 years. And they would say, we're comfortable here. We have resources here, all of which is correct and all of which have benefits. But they then also claim to be data driven, which I don't think they should be able to claim, because the data tells me that each year the best cities to invest in America change. Now, sometimes the same city comes back twice or even 3 times. I've seen, Provo, Utah come back, in our numbers twice, and we've seen Boise, Idaho come back twice. Phoenix has come back twice, but often these are not consecutive years. And one could say, well, yeah, but if I have resources, then maybe my city is better than opening up this new metro, and you'd be right. But is it better every single year? And that the answer to that is an emphatic no. There are no cities in America. Since I started looking at this, we have a system called Location Magic. More than 50,000 investors have used it. We have never, bar none, found a city that is in the top 2 or 3 every single year for the last 10 years, simply because that by itself is strange. Because if that city was at the top that often, the everything there would become so expensive that it would drop out of that top 3. Does that make sense? By its very nature, the fact that investors there get very rich and get very greedy would cause that city to fall out. So there is no best place in America to invest. There's a best place in America to invest every year. And that's what our location magic or real focus system is based on. So as I started investing, I realized I needed to create a system that I could use. And early on, it was just me. Now we have 29 employees, so we have a lot of people just crunching numbers all day. But back then, I needed a way to figure out the best cities to invest in America, and I needed to be a straightforward system, not a black box, but a straightforward system. And we came up with something, and it had 17 different parameters, and we still use versions of it now. But then I was like, what if I wanted to give this away to other people, right? People that, don't have to buy anything from me, don't have to get a subscription. They don't ever have to come back and ever talk to me again or my people again, but something that's valuable. What if I wanted to give it away? Then I realized I need to actually simplify it. It's still complex, but it's fairly simple. So my goal was someone should be able to pick up a random city that you've never heard of. You go to a party and some people are discussing some city called Killeen, Texas. And you're like, Killeen, Texas. Okay, I want to know if Killeen's a good place for real estate investment. And not just that, I want to know, how does it compare with 5 other random cities that I heard about in last week's party, right? Mm-hmm. So you want to be able to compare and contrast these cities together and give them objective scores in terms of how good they are for real estate investment. So with that in mind, we basically went and started to implement such a system. I hired both a person to scrape, websites from the web. I hired a person that is a statistician. So I'm a data scientist. So these statisticians basically start taking large data sets and sticking them into a software called R, all with the goal of figuring out what really matters when it comes to profit, because the only thing we cared about was one thing: what creates the most amount of real estate profit, both in the short term, the medium term, the long term? What are those factors? And how do they change? How do they change over time? And so we put in all kinds of factors, and some of them you might think about, like school scores and population growth and job growth and income growth and home price growth. So we threw in, the kitchen sink at it. And then we started looking at the profits that investors made and tried to figure out which ones of those factors correlated the most to profit. Where was the correlation the highest, and where was the correlation the most? We also looked at, okay, maybe schools are highly correlated to real estate profit. But if I remove schools and I put in this other factor, maybe I get the same correlation, in which case I don't need the schools. I can take them out because the other factors are basically adjusting for it, right? Let's say you have high quality of schools, you probably also have incomes going up, you have job growth happening there. So maybe those are just for schools, right? So those are the sort of things we were thinking. So we kind of throw lots and lots of things at it. We come up with like 50 different versions of it and see what actually leads to the maximum profit. And then we do something really important. That's called back testing. So we look at the profit that's been made in 100 cities over the last 10 or 15 years, and we say, okay, we think these are the best factors. Okay, let's apply them to that back testing and see what percentage of the time they work. And maybe they work 95% of the time. Then we go back and change our formula, and now it works 97% of the time, which is an awesome number, right? So that's what we were doing. And we eventually settled with 5 factors. And disclaimer, this is a free system. It's kind of like Wikipedia, or it's something free that we're giving away. You never have to come back to us. Every year we update it, so you can come to our website and grab it and go away. You never have to buy anything. There's never any subscription. There's never going to be any subscription in the future. I can say that in public, because it was never really designed to hook somebody into a system. It was designed to give people an easy way to figure out the best places to invest. So we came up with a system that has 5 parameters. In the future, it might have 6, or it might have 4. Data changes our mind all the time. And I'll give you the 5 parameters, and then I'll give you examples of those parameters. They're very specific. Any city that you invest in should have a certain amount of population growth, a certain amount of job growth, a certain amount of income growth, a certain amount of home price growth, and a certain reduction in crime. Okay, so we're looking, for a city to have these 5 things. And you might say, well, yeah, most cities have those things, Neal. Yes, but we're looking for specific amounts of those things. Okay, we're looking in all 5 categories. We're looking for the amount of each of those metrics that makes that city significantly above average. It doesn't make it the fastest city in the US, because then, we'd never pick any cities, because no one city in the world could have the fastest population growth and the fastest home price growth and the fastest, this and the fastest that. It's never going to work out. So you can't really pick the best in each category. You've got to pick above average in every category, and significantly above average. So we came up with numbers. These numbers change once in a year. They change in January every year. So I'm going to give you the 2021 numbers. And I have to tell you, the 2021 numbers are the wackiest ever, but you guys know why that is, right? It's because of COVID, right? So some of the numbers haven't changed much at all. Like the first number here, it doesn't care about COVID at all. It's population growth. And the city that you invest in should have 10.5% population growth between 2011 and 2019. You might say, I'm in 2021. Why is it 2019? Well, because I wanted to use public data. I didn't want to gather information about 600 cities and sell it to you at $10,000 a year. I wanted you to be able to get public data. And so we on our website, we have a place where you go and you get the data. And then it also tells you how exactly to get this data next year, because you don't want to come back to our website. We tell you, go here, click this thing, take these 2 numbers. That's how you get it for next year, right? Simple. So we want 10.5% population growth between 2011 and 2019. And just so you know, that's roughly double the population growth of the United States as a whole. We find that when populations move into a city, and they aggressively move into a city, all kinds of crazy stuff happens, right? For example, Boise, Idaho had rent growth in the 30% range in the last 12 months. Wow. 30% range, right? And nationwide, we look for rent growth to be 2%. 2% is kind of the median. It's more like a 2.4% median rent growth, is the nationwide number. So Boise, Idaho had 15 or 13 times the annual rent growth of the US. And the US was also experiencing a good year. So, it's not really 13 times, it's maybe 3 or 4 times, but still these numbers are the greatest ever in history. And what happened to Boise, Idaho in the last 12 months? Well, Boise became the favorite place for people who could leave because of COVID from San Francisco, from New York, from Los Angeles, from these ultra big metros, the people that could leave and go to a nicer, better, more, interesting place to live in. Well, Boise was number one, right? Phoenix was
Wow.
number two. So when those things happen, when population grows, people might think, so the population is growing 10.5% between 2011 and 2019, Neal. That's like 1.5%. I mean, what's the big deal? Well, here's the thing: 1.5% population growth often spikes rent by 4 to 5%. So
Wow.
rent spikes are not at the same level. They're parallel, but it's not the same line, right? So that number by itself is so powerful. Unfortunately, this means that you can't invest in the Midwest, where Detroit's losing population and St. Louis is losing population, and so many other cities have lost population. No, you can't. You can still invest in Detroit, because I'm going to give you 5 rules, right? What you want to do is invest in cities where at least, if possible, all 5 rules, the city crushes them. That would be best. But you may not want to invest in those cities because they're 3,000 miles away from you. You want to invest in a city that's 300 miles. Well, in that case, you might want to drop to 4. And if it doesn't work, you might want to drop to 3, but only if the city crushes 3 of the rules and doesn't quite make the other 2, but it's not off on them a big deal. Maybe it doesn't make the cutoff. Maybe the cutoff 10.5%, and some place that you were looking at, it was 10.2. So you were just below the cutoff for 2 of them. And then you crush the other 3. Maybe you look at that city. Now, if it doesn't make 3 out of 5, maybe you don't want to use this system. Maybe you're just a gambler and you should be continuing to gamble. Maybe you shouldn't even invest in real estate. Las Vegas might be a better place for you to be investing your money in. So, beyond the 3 out of 5, the system really breaks down and loses value. Obviously, the cities that crush all 5 are going to be incredible investments. So,
Can I
yeah,
pause you for 1 sec here, Neil? I
yep,
just want to say, those listening as well, is whether you're interested in actively investing, doing houses or apartments yourself, or passively investing. Neil's group does this, our group does it as well. Take passive investors to do deals. It's so important that you're in the right areas, because there's the saying, you've used this before, Neil, that the idea of the rising tide, brings all ships up. And so I've seen it before. People don't necessarily perform that well in a market, but because the market is performing well, things do phenomenally well. And so that's the whole thing of why, when I was doing single family houses in Cleveland, and I ended up selling them all and getting out of there, because I realized, like, the population wasn't growing. It was flat or declining. And so just that idea, I think, for investors or people interested in growing their wealth, is being in areas where the tide is rising. So you continue on. You said you had those 5 metrics. The most
sure.
important is it population growth is the most
I
important
wouldn't say
one?
it's the most important. It's just the first one,
One of them.
right?
Okay.
The second one is median household income. And by the way, for those of you who are like, I didn't write that first one down, that's okay. I'll give you a website at the end that stores all these rules. So you just go there and grab them. So we're looking for 35.2% median household income between 2000 and 2019. And once again, you're like, yeah, not just a rule. How do I get this information? How do I know that city A, city X is there? Well, the rules and where to get them are all stored on the website, so you can go grab those. So 35.2% median household income growth between 2000 and 2019 is what we look for. Once again, you're like, but we're in 2021. Well, the public data is available to 2019. I've also got a secret for you, right? I'm going to mention 2 websites that have this data. They're paid. They cost about $2,000. I'm not affiliated with them. One's called housingalerts.com. The other one's called localmarketmonitor.com. I subscribe to both. I think they're great sites. They have incredible data, fantastic value. What I've found, though, is when I use this 2011 to 2019 data, and their data obviously is newer because they're paid sites. They don't have 2021 data, but they have 2020 data, so they have an extra year. I came up with the same list of cities, right?
Fine.
Nothing changed. I ended up investing in the same exact list. And so one of my rules of thumb, not rules, but rules of thumb, is cities don't change over years. They change over decades. The only exceptions to that rule are Hurricane Katrina or Amazon HQ. So when a massive event, negative or positive, happens, cities change quickly, but otherwise they change very slowly. Cleveland, for example, has been kind of a flatline city for a long time. It was losing population and almost stopped at this point. There's very little population loss, right? You look at Connecticut, kind of similar sort of position. But you go back and look at Connecticut 15 years ago, it was very similar. It wasn't very different from how it is today, right? And over 7 or 8 years, things changed. Like Phoenix has incredible population growth at this point in time, and really wasn't there 8 or 9 years ago when it crashed and burned very hard. But 5 years ago, Phoenix looked just like it is today. So cities don't really change over a year or 2 years. So I would suggest to you, sure, you do what I want, do what I do, pay for local market monitor, pay for housing alerts. You're probably going to end up with the same list of cities as the free data that I'm going to share with you. So median household income is key, because what I found is, first, you want people to move into an area. When people move into an area, they basically buy everything up. They use the resources in that area. So the resources become scarce. And one of the resources that becomes scarce is manpower, right? Because, all ships are raised. They're using resources. More resources need to be created. More haircuts are needed. I got one yesterday. More, not for Bronson. He's sad. But for me, more haircuts, right? More toilet paper is needed. So essentially, more manpower is needed, right? So what happens is, because population has increased, more manpower is needed. When more manpower is needed, there's more competition for manpower, which raises income. So median household income goes up when population goes up. They sort of go up together, and that's why it's number 2. You want that 35% number. Moving on to number 3. Ready to move on to number 3, Bronson?
Yeah, let's do it. No, this is great. I think it's obviously we're getting in the weeds here, but I think it's really obvious that this stuff, you've tested it, and I think you're right. There's an underutilization of data that actually should lead the conversation, and you can live where you want, like you and I live in California, but you invest where the numbers make sense, and this is it.
Well, and before I go on to that, I'll say I eat my own dog food in 2 different ways. Okay. 60% of my investors are Californians, and the number 1 request is, you never invest in California. We love California. And the answer is, the numbers don't permit me to. And I would love for California to show up at the top of my numbers, because that would be the easiest money raise of my life. Right. Yeah. But I've never invested in California, and I don't think that's going to change, just so you know. And the second thing I want to say is, I am the only syndicator that I know of in the United States that actively invests in 10 different states.
Wow.
So we're in 10, and we're going to add in 11 soon, 10 different states, because the numbers drive me to these states, right? And I invest in places that you've never even heard of. My most profitable property is in Dalton, Georgia, a tiny little sleepy suburb, 35 miles from Chattanooga, 90 miles from Atlanta. Right? Wow. My second most profitable property is in St. George, Utah, which is so far from everywhere else. You can actually drive quicker to St. George from Las Vegas than you can from Salt Lake City, which is in the same state. That's how far it is from everything, right? Wow. Second most profitable. Point is, I know about these cities because I've always found for the last 4 or 5 years pre-COVID that smaller cities made the most profit. And people don't do it because they don't have the data. They're afraid of these smaller cities, right? I've been screaming about Boise since 2017, 17, 18. I was screaming about Boise and Provo. As you can see now, these markets have gone completely crazy, right? Provo is a sub 4 cap market, right? And Salt Lake City is still a tertiary, and Provo is 50 miles away from Salt Lake City, and it's a sub 4 cap market, right? So you look at what's happened to these markets because their demographics were just so phenomenally over the top that I was like, I got to put all of my money in. I mean, Provo is our biggest project. It's $130 million. I'm so glad we made that call. So anyway.
Real quick, Neal. So it sounds like too, it's not just that you're getting, notifications or you're seeing these pop up as top things, like they've been top areas, but they're really leading indicators that this is what is going to happen. So it's not just that it's hot right now, it's because they move over decades and over long periods of time. You see kind of the ramping up of Boise, and you saw the ramping up of Provo. Is that correct?
Yes, and I'll explain it in stock market terms. So the stock market has 2 kinds of investors. One investor is called a fundamentals investor, or the Warren Buffett investor. And they look at all of the fundamentals, like the ones that I'm just mentioning, for a stock, and they invest accordingly. The second kind of investor, more popular, is called a momentum investor. They look at the momentum of a particular stock and they say, I don't really care about the underlying fundamentals. This is going to go up, so I'm going to invest in it, right? So the 5 real focuses, the ones I've given you so far are fundamentals. The 5th real focus is momentum, okay? And that's jobs. And for all of the others, we give you long-term time parameters. For jobs, it's the last 12 months, because no other indicator that we found is as much of a leading indicator of future increases in prices than job growth in the last 12 months. Because it's only when people get jobs and there's a fight for jobs in the last 12 months that people start to get comfortable with buying stuff. They buy cars, they buy houses, they rent newer properties, they upgrade, they do all kinds of things, and that leads to future pricing bubbles, both in the for sale market and the for rent market. And so that last indicator, jobs, is a momentum indicator and is the strongest of them, right? So there are some advanced people that have come back to us and said, hey, I use your real focus system. I think it's great. You know, you've got 5 parameters. Do they all have equal weightage? And the answer is no, the jobs, they have 40% weightage. So the first 4 are 15% each. So that's 60% weightage total. And then the jobs have 40% weightage, because jobs is the momentum indicator in real estate. Nothing else indicates momentum as much as job growth in a particular market. That's why I'm so fanatic about job growth. And there are cases where I've made exceptions, and almost inevitably, every single case that the exception was made was because the job growth was very high, even though some of the others were fairly weak.
Yeah,
so
no,
Dalton, Georgia is perfect. Example of that.
Yeah, that's amazing. I think I love that. It makes perfect sense too, right? The jobs are what provide the momentum and really help you to know where things are headed. So I think I love it. I love I didn't realize you are a data scientist. That's your background is in
data science. Yeah. So, computer science is my degree, and data science is basically the background there. So this kind of helps me see these kinds of trends. I tell people, I'm kind of like Neo, right? I'm trying to read the matrix, and sometimes it works and sometimes it doesn't, but luckily it works more often than it doesn't.
Yeah.
Right?
Awesome.
So number 3 is median house and condo value. So you want to go into a market where median house and condo values increase by a certain amount. Now, having this number that I'm about to give you is almost too easy to hit because of the incredible increase in home price increases in the last 12 months. So we're looking for 47% increase. Just so you know, this is a preview. We're crunching numbers now for next year because the system comes out. This is going to jump by almost like 15-16%. So you may want to just add 15-16% to this number. That takes you up to like 63% between 2000 and 2019. Once again, that's the last 9 years data. That's public data. That's very easy for you to find. And we only want to go in those markets. And still, even despite the 16% jump, you probably get about 40% of all markets in the US that will work, maybe even 50%, right? Because prices are going up so much. So this is the one parameter that I want you to be a little more aggressive with, but know that in the long run, I want you to come back to these numbers. We are in crazy times. We are in a time when we've just printed $7 trillion. Everything's going to go up. We think that temporarily it's okay for you to look for numbers higher than 47%. Maybe you look for 63 or whatever that number is. But then in the long run, I think the number needs to moderate, because obviously this kind of growth, this madness that we're in, is completely unsustainable in the long run. There's no way, because incomes are not going up, so it moderates. So when it moderates, we'll come back to somewhat softer numbers, but for now, big numbers there. So that's number 3. Number 4 is one that is a little complicated, and so our website actually contains instructions on it. There's a crime index on a website called city-data.com. There's a crime index. We ask you to invest in cities where the crime index is lower than 500. This doesn't change every year. Unlike the population growth and all the others, this index remains the same. We only change it once every 5 years. So despite all the nonsense that you hear about in the news, crime in the United States has been declining for 27 straight years. It went up fractionally last year, given the crazy year that we had, but we actually expect it again to decline in 2021. So, violent shootings are up, but overall crime is declining in the US. So we want to go to cities where this number is lower than 500. And once again, I'll give you information on where you can go and grab that information. But 500 and lower, basically what we found was, Bronson, was that there was a very key correlation between decline in crime and profits. There wasn't a correlation between low crime and profit. So let's say that you're living in some small city in North Carolina and it's near nowhere and its crime is low. There's no correlation to profit there. But what if there was a city in North Carolina where crime was high, but had been rapidly declining in the last 5 years? Rapid decline. There's a very strong correlation to future profits. So it's decline in profit that really, decline in crime that actually creates profit, because people start seeing the place differently. So we've got the data for you. It has to be below 500, but we also want to see a rapid decline. We show you exactly how you can look at, 2 years ago, 5 years ago, 10 years ago, it's crime declining consistently. That's why, you invested in Cleveland, but my pick for Ohio has always been Columbus, because Columbus's crime decline has been astonishingly rapid in the last 12 or 13 years. A lot of it has to do with education and healthcare. They focused on it. Their city bonds are healthcare based. So, when a healthcare population comes in, they're not looking to commit crimes. They're looking to save lives. Right. So a city that has a very strong healthcare or education focus tends to have, continuous multi-decade decline in crime. And that's why, for 5 or 6 years, people who've heard this presentation have heard me mention, Columbus as kind of the alpha city. And you can see that. I mean, cap rates in Columbus are in the 4.5 range today, which, given that Ohio is a Rust Belt state, is an astonishingly low number. But it didn't get there in a day. Last 5 years have been phenomenal cap compression there. And cap rates are compressing everywhere, but there's no way Connecticut and Cleveland cap rates are anywhere close to Columbus.
Well, it makes sense if a place is redeveloping and there's more effort, being given to a certain area, or, things are happening positively and crime is reducing. It makes sense that would be a very positive indicator. So I think that's really great that it's one of the numbers. Yeah. Right.
And keep in mind that crime piece allowed us to leave the schools out, because we found that schools were so variable for rent, for buying stuff and holding it. Like if you're buying single family homes, schools are just indispensable. But we are in the multifamily, large scale multifamily market. But even if you're buying a 20-unit multifamily, schools are not as important as crime rate reduction. Believe it or not, we didn't find a clear correlation between schools. I mean, we have properties where schools are 10. We have properties where schools are 3 out of 10. And we are not seeing a significant difference in quality of population, which is counterproductive. But again, you have to listen to what the data says, not what your gut says.
Right. Yeah, that's why data is so powerful. Yeah.
Right. And then the fifth one, the big parameter, is job growth. Job growth percentage over the last 12 months. Long-term job growth has zero correlation to profits, right? But short-term job growth, the last 12 months and even the last 6 months, it's kind of hard to calculate it for 6 months, so I give you 12 months. But the truth is, the last 6 months has even more correlation to future profits than the last 12 months do. So it's a momentum-based indicator. And we get this information from a website, which, again, the URL is stored there. We want 2% job growth, and we give you a way of calculating it during COVID. Obviously, all the numbers are messed up during COVID. So we give you a way of calculating that 2% job growth during COVID. We expect starting 2021, 2% again will be fine. In a country where job growth is usually in the 1 to 1.5% range, 2% is good. 3% is awesome. 4% is champagne bottles. 5% is you can buy the shittiest property and still make a obscene amount of money. Very few metros consistently stay above 5. And some of the metros that I like the most have stayed in that 3 to 5 range. So they bounce up and down. So Provo, Utah, St. George, Utah are 2 that consistently bounce up and down. Boise, Idaho bounces up and down in that 3.5% range. Austin is usually doesn't go up to 5, but it stays in that 3+ range continuously. And for Austin, of course, 3+ is like 5 everywhere else because it's tech jobs. So, you kind of also have to look at the quality of the jobs that are produced, and Austin produces consistently the highest quality of jobs in the United States outside of the San Francisco Bay Area. So these are some amazing places that job growth has been phenomenal. Raleigh, North Carolina, Charlotte, North Carolina. So North Carolina is the only state, or apart from Utah, where we've seen 2 metros that stay in that high range, and sometimes they come down to 2, but then they bounce back up. So job growth obviously varies from month to month. But these are markets that are absolutely insane. And Dallas is not in there, but because it's pretty strong, it stays between 2 and 3%. It's one of the top markets in the US. But from a job growth perspective, Dallas is just not as strong as some of the other markets. It was in the past. As I said, maybe looking at 100 different pieces, Dallas might be the strongest market in the United States. But from a momentum-based perspective, at this point, San Antonio has far greater momentum, and so does Austin.
Yeah, well, Neal, I love this. I know a lot of people that may be hearing this for the first time, or the first time I heard it, I was just like, wow, this is really amazing stuff. And I know you've created some resources around that I want you to be able to share. But I just wanted to really say I appreciate you for coming on today and sharing this. I think that a lot of investors just kind of, it's almost like rolling the dice. I want to invest here. I don't know where I should invest. But when you actually look at data and you have some specific data points that you've back tested and really created a system that people can use for free, I think that's awesome. So I appreciate what you do. I know you also work with investors. You mentioned you have 10 deals going on this quarter, which is awesome. So if you're watching this or listening and you want to reach out to Neal and his team, they're a phenomenal group of people. So reach out to them. But Neal, how can people get in touch with you or get in, kind of follow this system a little bit more?
Sure. So first I'll tell you about, how to get in touch with me. I happen to be the only Neal Bawa on the World Wide Web. So Neal space Bawa, hit enter. You'll see information about me. You'll see a couple hundred podcasts. If people are complaining, you'll see them. Yes, all of the complaints, that's me. And all of the good stuff, that's me too. So that's the easiest way to get in touch with us. And you'll see, our investment opportunities. We have 22 active projects running. We have about 10 of them launching, including one that's in a fund. And the other way to learn more about this system that I just mentioned, all of the pieces that I was talking about, how to put them all together, how to get an Excel spreadsheet that just makes it easy. That spreadsheet lives on the homepage of multifamilyu.com. So about 50,000 people come there each year to pick up all the different resources. There's an astonishing array of resources there. The one that has this spreadsheet and this system is called Location Magic. It's halfway down the first page. Go there, grab it. There's a webinar. It's 1 hour long. It's more in depth than what we just had time for in this podcast because I need to lead you through the numbers. Watch it. Grab the Excel spreadsheet, grab the PowerPoint deck. You're good to go. You never need to pay us anything. You never need to come back if you don't want to.
Awesome, Neal. Well, I appreciate all the value you're adding, and this was a great conversation today. I think a lot of people hopefully will, 5 years from now say, man, I'm really glad I listened to Neal Bawa. I used his program to help figure out the right market. So appreciate all the value you're adding to everyone.
Awesome. Thanks for having me on the show, Bronson.
All right, so as you can tell, Neal Bawa knows his stuff, right? He knows about data. He's a data scientist. He looks at all the stuff, the back testing, population, job growth, income growth, reduction in crime, and increase in single-family house or condo prices. These are all, like he said, leading indicators, particularly the job growth portion. So it is really important where you invest because of the numbers, because of how many people are moving there, because how many jobs are there. All those things are really, really important. So like, for example, our group, we typically buy mostly in the South, where we are seeing a lot of population growth, job growth, income growth, especially even during COVID, when a lot of businesses are moving, a lot of retirees are moving, particularly to secondary markets, such as Jacksonville, which we just recently closed a multifamily deal there. So anyway, I hope this was valuable to you. I think it's really important that you look truly at data and systems and try to find systems that work for you, like whether you're doing single family, multifamily, whether you're investing actively, meaning you're doing the work yourself, or you and your team or team members are doing it, or you're investing passively. We have a lot of passive investors that invest passively with us. I know Neal's group does too. Feel free to reach out, bronsonequity.com, or like Neal said, his site is multifamily and then the letter U, multifamilyU.com. So thanks for taking the time to educate yourself, and we'll see you on the next one.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.